Shall we, Rao sir?
Yes, sir.
Yes, thank you so much. Good morning and welcome to all our friends who have logged in from all over India and outside. Thank you for spending this Sunday morning with us. I'm sure you'll benefit from it. Welcome to today's webinar, jointly hosted by ABSL and The Week. The topic being Edge of Asset Allocation. My pleasure this morning to welcome all of you, and especially the three panelists who are here with us today. I'll start with the fulcrum of this program, the person who holds it all together, Mr. KSRao, who's the head of Investor Education and Distribution Development for Aditya Birla, an IIM Calcutta alumnus. He's an MBA in Finance, a chartered wealth manager. Much and above that, he's a wonderful teacher and a great soul, a great human being. It has been our pleasure to be associated with him for a long time now. This is also my opportunity to congratulate Rao sir on his 1450th program, that is on ground and webinars together. That shows the wealth of his experience, the hours, the days, years he has put together in educating people about investment. Congratulations, Rao sir, on this milestone. So happy to spend this with you.
Thank you, sir.
This is also the program number 12,000 for Aditya Birla Sun Life Mutual Fund. Again, that's a big milestone for the company and for us, and such an honor to be associated with the company on this milestone. Rao sir will also complete almost 3 decades in mutual fund service in the coming weeks. So in anticipation, I'm congratulating you, sir, for your service to investors and your service to the nation. I would also like to thank and congratulate Aditya Birla Sun Life Mutual Fund for 4 new awards that they have received recently at the Nivesh Manthan Annual Awards for Investor Education. These awards honor fund houses and people who are associated with investor education. These awards were given out last month in June. Of 6 awards, ABSL won 4. Best Fund House in Overall Investor Education, Best in On-Ground Events category, Best in Social Media, and Best in Books and Booklets category. So that is a huge sweep at the awards. My congratulations to Rao sir and his team. And when it comes to books and booklets, usually the team puts out downloadable booklets in the chat section. Please do download them and use them. They are very helpful, very useful. I'm sure all of you will benefit from it. It is so many of our viewers have constantly asked for those links, so that we keep posting them again and again over the event as long as the event goes on. And I'm sure the ABSL team will do that. And please do keep your eyes open for that. It's also my pleasure to welcome Amit ji from Karmayol Knowledge Academy, and also a speaker, trainer, blogger, and a very dear friend. We were talking about Amit ji's father, Mahesh ji, who passed away last year. He was a pioneer in blood donation, and a video about his work has come out and is on YouTube. Please do look out for it. That's a great son of a great father, and it's been our pleasure to be associated with him. And also he brings in a lot of humor, a lot of Bollywood, a lot of cricket into our sessions. Just before we started, we were talking about the rains and about this, and he joked that, you know, in one place there's a lot of liquidity, and in another place liquidity has been sucked out from the market. So That's the kind of puns that come out from him. There'll be more today. And I forgot to say this, but one thing is that all three of them, Kiranji, Amitji, and Raoji, are excellent educators. They bring it down to a level of any person, even the level of a beginner, so that you can understand about university education. And I'm sure you all will benefit from it. Kiranji is a very dear friend. She's a certified financial planner registered with SEBI. I always say that she has run the whole routine from employer to entrepreneur, from employee to employer to entrepreneur. Certified financial planner with SEBI. She founded Financial Planners Guild India, founder of ABT Capital Advisors, and founder of Dhanayush Capital Advisors Private Limited. She's also an author, like Amitji. Mindful Retirement was one of these books, and their latest book is Money Wise. I don't know if you can see it. I think it is a bit out of focus. Money Wise Perspectives for Women, co-authored by Amitji and Kiranji. That shows that our relationship goes beyond the webinars. So it is my pleasure to welcome all three of them. And I also take 1 second to thank the team behind the scenes, Anand and Roshali from ABSL, and Rahul and Sridevi from the week. Thank you so much again for being with us, and over to you, Raoji.
Thank you so much, Matthew sir. Indeed, it's always an honor to have you and inaugurating every session. And I had a privilege to inaugurate and moderate and interview all the panel at an on-ground event last at Kochi.
True, sir.
And
Yes, sir.
we look forward for the next one at Trivandrum very soon next month. Hopefully, we can have
Absolutely,
Amit and Kiranji can travel to with us there. And thank you so much. And thanks to Amit and Kiran for the joining. And it's going to be a very interesting session with both of you around. And good morning, friends. It's on a monsoon Sunday and a wonderful day. It's a happy Eid. It's a Bakrid we celebrate today, and it is also called Ashad Ekadasi. And there are other festivals, and of course, it's also 10th July is called Global. What is that? It's a global energy. It's called International Global Energy Independence Day. It is a because it's celebrated as a Nikola Tesla's birthday. I mean, who has got a radio to the remote, which we have in our place, as invented by him. And but of course, today we are going to the basics. I mean, it is a season of monsoons. There is a seasonal change. There is a change in the weather. There is a change in the climate. And for example, Matthew sir is having a little bit of cold, and each location is very different today. Similarly,
correct.
markets too get some cold. Markets also sometimes have a different weather, and we have a discussion. And I quickly run through a few minutes of presentation. There will be some downloadable books my colleagues will be posting on the chat section. You can always download it, and or you can visit our website, mutualfund.adityabirlacapital.com. You have a lot of books to be downloaded. And today evening, we are also launching our new TVC, how you can have a pro portfolio. What is that in each of the seasons, what you need to look at. That's an educational educational TVC, which is being launched this evening along with R1 Day International. And with this, I thank Matthew sir, and I just have a screen to share on my quick presentation to take you around. We have a conversation which will go for next 90 minutes. I mean, maybe 60 minutes of 60 to 70 minutes of conversation. The rest we will have your questions, whatever is coming in. And we have two experts with me, Amit ji and Kiran ji, and it's going to be very engaging. And we'll try to answer all generic questions, these specific questions which are not answerable based on the regulatory requirement. Probably we are keeping it out. Rest, we talk about asset allocation, we talk about market volatility, we talk about mutual funds, how that can help on asset allocation. Welcome to you all. And before I go, and earlier some of you has put in the chat mentioning that it is not audible rightly. Probably if you are all getting it right, if you are audible and its audibility is fine, kindly put it why, and that will make little engaging session for all of us. And then thanks Kishore for confirmation. Thanks Rajiv, Anuradha. Thanks a lot for that confirmation. Pavan, it's fantastic. Thanks Vamshi. Thanks Venkat. Thanks, Mr. Atul Naidu, Vinayan, Arunachalam, Chetan Shah. Hi. Thanks, Anil. Thanks, Adish. Thanks, Raghavendra, Vinil, Bini, Desai, Matthew, Matthew sir around. Thank you so much for it. And with this, I think it's fantastic. Let us. I mean, probably if you need to note down some things, you can always note down. If you are taking the screenshots, fantastic. And later it will be there on the Facebook. You can have a relook at it. And this is what we can look at: market asset allocation, market volatility, and then we can look at what is asset allocation, what is the methodology of asset allocation, why we talk, and what is that necessity. I mean, how hope you have seen these numbers. Somebody says 80-20, somebody says 25-50-25, somebody says 50-50, somebody says 40-40-20, somebody says 25-25-25-25. And that session today is talking about edge of asset allocation. Edge kya hota hai? That is the EDGE. You have an equity, you have a debt investment, D is for debt investment, G is for your gold, and the last E is for real estate. What kind of asset allocations you need to look at? What is exactly an asset allocation? Asset allocation is a method to construct an investment portfolio, and it is to diversify your money among the different assets based on your risk and return profile. And the funds are going to be allocated to these assets, which can optimize your returns and minimize your risk. We can have a lot of conversations, a lot of experiences, and we can take you around. It shows, like, history shows that you don't know what the future will be. We can't predict. And the most important and key successful can be summed up in two words, which is called asset allocation. And asset allocation, it's like it's a there is a paper which is published way back in 1986. Gary Brinson. This paper, I mean, it's spoke about 90% plus of the times what creates a wealth to you is the asset allocation. I think in 1952 we spoke about the portfolio allocation portfolio, and 1972 there was a Nobel Prize won by Harry Markowitz for the portfolio and asset allocation, and which we call modern portfolio theory. And this is an importance we can take it forward. And what exactly an asset allocation? I mean, depending on your needs, depending on the way you intend to, depending on your aspirations, you can have a different kinds of asset allocations. There is a strategic asset allocation, there is a tactical asset allocation, various ways of asset allocations where you can look at, you can customize, you can optimize, but of course, you have your advisor with you. You can have a conversation, and your advisor will take care of that. If you want income needs, there is a high allocation to the fixed income. You are a balanced. Then in the mutual funds, you have a balanced, like BAF or hybrid funds. You have a fixed allocations. Then you have an aspiration to the higher aspiration, you want a larger wealth creation, then you are skewed towards the equity allocation. This is where you can look at asset allocation in a very different way. But let us discuss what is the asset allocation, what it means for you. It is your representation of your profile, and it's a roadmap how you reach your goals. You don't need to worry where the market goes. You will be looking at where your goals and how you are investing on. And you don't need to time the market, and you need to be in the market. And it's a nest allocation is it's not a static document, it's going to be a dynamic plan. You can change according to your profile. I call it the, like, you need to have a 3T factors: your time frame to be in the, like, your time frame where you can look at, and your tolerance to the risk. That risk tolerance is not the risk tolerance you always speak about. If I come to you in the month of Jan, you would have said, I am bullish, I can take any risk. But today, if I come to you, your risk metric would have undergone change. Your thermometer of the risk has come down. Your risk tolerance would have come down. This is called tolerance to the declines. You go to the hospital, I mean, diagnostic center, and you go your blood glucose level. You look at, there is a test called glucose tolerance test, GTT. Similarly, your risk tolerance, decline tolerance test. If market goes by another 10%, can you hold on to the same things you are holding on to it? You need to look at. And the last one is a trade-off between the immediate loss of appearing losses, but it's a long-term gain where you are getting, it's a long-term wealth creation. And you can look at why you need to discuss this. Various asset classes over a period of time, last 10 years, they behave differently. Not each of the asset class may not behave the same way. There are very rare instances, each of these asset classes, different investment category behaves very differently. They have cyclically respond differently to the different economic cycles. And in the simpler definition, how you can diversify among these asset classes with your risk profile and return profile, you can ensure the stability to your portfolio and calm to your mind, and you can have a consistency of the returns. And that's where you need to adapt a process, a strategy, what you need to look at. This is what exactly I was telling. It's a you are making, each of these asset classes will become a natural head to each other, and you have a weak or negative correlation among the asset classes can help. And there's a portfolio diversification. This is what you can say. Don't put all your eggs into one basket. And it is proved, like 90% of the times, asset allocation is the key where it can determine where you can create a true wealth. All depends on the timings. And we have heard the story of the diversification. Don't put all your eggs into one basket. This is to minimize your investment risk, minimize the impact of volatility, and the reduced time spent in the modern month. You don't need to monitor the portfolio. You can go into the auto mode. We will have those questions: how mutual funds can help you to auto asset allocation. It is helping your keeping your capital relatively safe, and it also provide you a little bit of a peace of mind. Don't worry about your investments. Rest. You can have a calmer things. And all that what you need to do is understanding various asset classes. What are the asset classes we invest? It could be a ownership asset class. It could be a lending asset class. Ownership is you are taking little risk. It is a equity, real estate, and commodities. And lending asset class is your fixed income and money market instruments. And how these asset class characteristics, ownership asset class, it could be a lesser volatile. Short time, it could be volatile, but long term, it creates a huge wealth. And it's a hedge against inflation. Lending asset class, it has a lower returns, but it can income generation is having a stability and short-term stability, but long-term you are compromising on the returns. When you mix these two and when you are doing, you are cushioning against the volatility. And this is where it will work. And the right asset allocation depends on various metrics. It can be different to each one of us. Probably we can put those questions to Kiranji, what asset allocation pattern she does for her investors. What is that? It can make a difference. Depending on the resources you have and depending on your financial goals and the time to the goal, and it is a risk appetite. As I said earlier, it is the 3T factors: your time frame to the goal, your tolerance to the risk, and trade-off between short-term and long-term. And and we all need to learn about these conversations. How do we invest in these asset classes very differently? And how to choose these asset classes? What is the frequency you need to rebalance? And what kind of risk you can take? We will have these conversations with Amit ji and Kiran ji. And what is the rebalancing? How do you allocate to the rebalancing? Each of the asset behaving very differently. For example, equity markets almost down from its peak around 12%. What is that your allocation today? Debt fixed income is looking very good as we go forward. There is an opportunity to you can make money. How you can rebalance your assets depending on that dynamic way. You can, enhance either, you can enhance your fixed income or enhance your stick. What kind of rebalance depending on your thing? What to buy low, what to sell high, how you need to balance and how you need to move forward. And what kind of these assets can have a non-linear returns, what is the correlation across these categories, and how positive returns you can get over a period of long term. We can have these conversations. All that you need to do is you have a debt and you have an equity today. If you are looking at 50-50 or 45-55, what you need to do is you can shift from one asset class to other, bring down the debt and increase the equity. Then your asset allocation is matched. With this, I'll stop here and we can stop sharing, and then I look forward to invite both of my friends. Give me a minute. With this, thanks, Kiranji. Give me a minute. Yeah. Now, getting back to our conversations, thanks to both of you for your time. And we have quite a good number of audience on Sunday morning on a festive day and on the asset allocation. Kiranji, I start with you, though we spoke in the presentation bit on the asset allocation. What do you feel? How do you define this asset allocation in a simple terms?
Well, thank you, Rao sir, for this very basic question. I think everybody has heard of asset allocation, but this is something which not many people are able to follow. So let me try and put it in a simple, understandable way. So as you mentioned in the presentation, it's all about not putting all your eggs into one basket. So you're spreading around your risk. Or if you look at it in another way, we always talk about having a balanced diet, a balanced meal. So you cannot have too much of one kind of thing. So your meal consists of, say, some protein, some carbohydrates, some fats, and some minerals. So there has to be a fine balance between these. So you can't have just one category of food. Likewise, in investments, if we talk about the four broad asset classes, which is equity, debt, real estate, and gold. So commodities, but basically for practical purposes, when we talk of investments, it's gold, and now a little bit of silver is coming in. So when you're creating your portfolio, you can't have too much of one kind. I mean, you cannot have maybe full 100% equity or 100% debt. There has to be a balance between all these. So you have to have a little bit of everything into your portfolio. Now, how and what, I'm sure as the discussion progresses today, we will get more details on that. But that depends on a lot of factors, as we saw in the presentation earlier that Rao sir was mentioning. It depends on basically your risk tolerance level. What are your goals? How far are your goals from today? And what are the products available? Because at all times, all products might or might not be available. So there are so many factors that impact asset allocation. The basic understanding is that you're trying to make money for your goals in future, and you have to adjust your portfolio in such a way that you have the maximum possibility of achieving your goal, because we don't know what asset class will work in future. And by doing asset allocation, you are increasing your chances of achieving your goal. That is what asset allocation is all about.
Thank you so much, Kiranji. And it is you put it in a simple terms in a very effective way. I mean, I liked it. The balanced diet. Your asset allocation is balanced diet. It's a cushion, and you ensure that you are there. You are getting your optimized returns. And probably look at another analogy is somebody is going to a cake shop. I can get a very tasty cake. But if I have to get that tasty cake, I need to go to the chef and ask what kind of mix he has done, whether it is flour, sweet, sugar, or essence, but what kind of proportions and what kind of timing to bake that, all that creates this wonderful cake. If I experiment without knowing, either it can be a bitter one or it can be a powdered one. And this is where our returns can get there. Taking this conversation further with you, Amitji, we always talk about debt equity ratio in one's portfolio, and we all got used to their thumb rules we need to have. Do you feel investors should have any thumb rule for the equity and debt?
So, morning everybody, and thank you so much for this wonderful initiative, Team Week and Rebalancing Life Mutual Fund. It's very heartening to see more than 300 people participating live on Zoom on a Sunday morning. It actually is a booster dose to the confidence of all the panelists. So thank you so much, everybody. Rao sir, can there be a thumb rule to what kind of debt equity mix one can have? A lot of people have tried certain thumb rules, but those have some limitations. So the most common, most popular of the thumb rules is 100 minus your age should be in equity, and the age, that much percentage should be in debt. So that is a standard or one of the most common thumb rules that people use. However, there are limitations. The limitation is that let's take a 40-year-old, two people of the same age, 40 years. One is married and has two kids and parents to support, dependent parents to support. The another one is married, both the husband and wife are working, their parents are independent, and there are no kids. Now, in both these cases, the situation differs. And in such cases, the thumb rule cannot be blindly applied. Having said that, in a lot of cases, people find going into the details a little cumbersome. And in such a case, the process of investing in the right manner doesn't begin. So then random haphazard investments are made. I think as against going absolutely randomly, going by the market swings, etc., one may start with a very simple thumb rule like 100 minus 1's age, but as you go, keep refining that thumb rule in line with your individual situation. So thumb rules could be a good starting point. That's about it. Beyond that, personal finance, and as you rightly keep highlighting very regularly, personal finance is personal first and finance later. So each individual or each family's requirement is going to be different. And from that point of view, how much money should be in equity asset class or debt asset class or commodities or gold asset class is a function of each individual situation. And as Kiran was elaborating on the various needs, various constraints, availability of products, taxation. So all these things also, all those factors also play their vital role in arriving at a proper mix for an investor.
So much, Amit, and it's a different folks, different strokes, and different asset allocations, and we can work very differently. Taking this forward, I'll go to Kiranji. I mean, she advises many of our investors on various asset allocations. Kiranji, should there be a different asset allocation plan for each investor for each of the goal, or it could be a common to the entire portfolio of an investor? Will that be a goal wise or for an investor wise?
Right. So, see, this is a very common confusion that people have, that how do we actually approach this entire asset allocation concept when we are practically putting it into practice. Now, let us look at two concepts that are playing in here when we talk about goal-wise asset allocation or overall asset allocation balance. So, one is that money is fungible. So, whether you dip into investment A or investment B, when you have a goal to be met and that needs funds, it will not make a difference from which part of your investment you're pulling it out, as long as you have the money when the goal is coming up. Second part is that there is investor psychology. So when there are specific goals, like say someone is planning for child's education. So if you allocate a certain part of your investments for that particular goal, mentally people say that, okay, this is for my child, I will not touch this. So in that manner, it helps to have a segregated, goal-wise investments and asset allocation. But come to think of it, when we are looking at, investments, so normally what happens is there is a lot of investment which happens indirectly. Say, for example, somebody is a salaried employee. So there is some portion which is going into the EPF, which is a direct deduction from the salary. So that is a huge chunk of your investment which happens regularly in debt. So if you ignore that while you're creating your asset allocation, on an overall basis, you will have too much debt and too little equity. So there has to be a two-level thinking on this. So one, you look at where you stand on an overall basis, including all these indirect, investments, whether it be in EPF or NPS, which might be happening through your employer, and the investments that you're doing on your own. So they could be mutual funds, there could be PPF, there could be some bank deposits which are there. You could be putting in some money for your children in the small savings, like the Sukanya Samriddhi scheme, or even a senior citizen scheme in case of people who are senior in age. So all this needs to be built in together. So first look at the overall picture and then break it down into things which are not logged in, like say a PPF and EPF, and then come to the asset allocation basis your overall portfolio. So I think that would be a more practical way to implement the asset allocation on a portfolio basis.
Thank you so much, Kiran. I mean, it's always you give a perspective in a very holistic way. I mean, most of the times when I look at my goal and allocate according to the goal, but we tend to ignore because EPF and PPF, this is normally not visible anywhere. I mean, even you get a NSDL or CDSL CAS, it is not visible. And already we are allocated and we are into the over debt, like over carbohydrates and eating all the. Yes, Amit, you want to add something?
So apart from the EPF or PPF investments, one also must keep in mind if there are any ESOPs available from the employer, but that could be a huge chunk of the equity portfolio. And again, single company. Also, the problem compounds because now your active income, the salary, and your larger part of your wealth, both are concentrated only in one company. So one needs to keep that also in the overall picture. And the second part is when we look at the debt versus equity allocation, like the previous question that you put to me. A lot of times people consider their debt and equity by adding PPF, for example, or EPF, for example. Then they ignore the one component which is called liquidity. Because many of these debt instruments are illiquid in nature. So you also got to take care of that liquidity in that asset allocation equation.
Right. So if I may add, I just saw somebody has mentioned in the chat regarding REITs. So, I mean, yes, real estate is a part of your overall portfolio allocation, but how do you account for it? See, if it is your primary house that you're living in, you cannot really sell it and, make it into an investment. So it actually should not form a part of your investments. But if there are other properties which you are willing to sell to raise money for goals, yes, that can be a part of the overall thing. But again, as Amit was mentioning, liquidity is very low on that. So would you really want to make that into a investment portfolio which is rebalanced at a particular interval? So all these factors have to be looked in together. It cannot be a standalone basis.
Fantastic. I think, kudos to both of you for giving those fine tuning. I mean, I always enjoy this because broadly, when you are reading about allocation, or I can, switch to some YouTube and learn something, I can't get what to ignore, right? It's like the way when we thought about EPF and PPF, and then Amit comes in and talks about ESOPs. These are the hidden one, micronutrients and macronutrients, and micro is forgotten in our daily eating habits kind. And also it's right on the reads and the house you are holding on it, house you are holding on, just ignore that is an asset for a lifetime, and it is not part of rebalancing part to get there, and how you can get the reallocation. And it's a very holistic approach, and we'll take a lot of these questions. Friends, I request each one of you put it in a Q&A, so that we don't miss chat. What happens is in between a lot of conversations coming in, and put it on the Q&A side. Amitji, I'll come back to you once again, and this is the current markets. Probably, we are doing this webinar series over last 2 years with a week, month on month. And many a times when we did, market may not be the same. But fortunately, majority of these 2 years time, we have seen a bullish node, and it was an upward curve. And not only equity, even gold was looking good. Right across, fixed income is looking good, but equity is down. And then, gold is little more volatile. Either on the taxation or on the global war conditions, you get a different perspective. And at this current scenario, how does asset allocation helps the people, and what is your guidance? And the follow-up question I can put to you is, earlier somebody has asked on the REITs, but if I ask, what kind of allocation people should look at to the mutual funds?
Okay, so first of all, this is a very brilliant question, and a lot of times people ask that when markets are so uncertain, how can I do my asset allocation? A lot of times when the markets are good, anyway we forget the phrase called asset allocation. So because whatever is moving up, the money chases that asset category, and this is a typical behavior that we've been observing for decades or maybe centuries. So if that's the case, what should you do? What the basic idea behind asset allocation is, as you put it on your slide also, that it is an investor's, it is a representation of an investor's personality. So if my personality says that I can't, like a thing, or I can't tolerate a few things for various reasons. Let me take an example. That let's say if I am driving on the Mumbai-Pune expressway on a normal non-rainy season day, and there is no truck traffic also on that road on that particular day. And these are assumptions. So at what speed would you drive? Because Mumbai-Pune expressway is a wonderful, broad road, excellent surface, very well-maintained road. On that road, at what speed would you drive? There is a friend of mine, and we used to call him that he doesn't drive fast, he flies low. So that's the speed at which he used to drive. Typically, if the speedometer shows anything below 120, he would be uncomfortable. But when I drive, if the speedometer crosses 80 meters on the upside, 80 kilometers on the upside, then I would be scared. Okay, now that's my tolerance to speed. I'm not saying risk tolerance. That's my speed tolerance. And to that extent, just because the road is empty, should I go at 150? No, I can't live with that speed. So if there is a bump in the road, can I apply brakes in a timely manner to avoid the accident? No, if I can't, then I'm scared. Then that speed is not appropriate for me. Exactly the same thing happens in a rising market. You got that Mumbai-Pune Express Highway very empty. Should you press the accelerator and go at 150? The moment there is a bump on the road, you are not going to like that accident. In that case, it is better to maintain that speed of 80, which you can control and you are comfortable with, even when the others are racing past you. In the portfolio also, it happens the same way. If my portfolio in a bull market underperforms everybody else, I should be okay with it if I can't handle the downside. And while on the way down, if I'm aggressive enough, I can keep doubling up my investments or adding to my portfolio, because I know that I can tolerate this downside both financially and psychologically, so that when the rebound happens, I will have acquired a large number of units and I'll benefit or rather participate in that upside and benefit a lot. Okay, so that asset allocation must be looked at in that context. Just because the market is going up, should you load up that asset category? Then we are actually chasing past performance. And often, as the mutual fund advertisement says, past performance may or may not be sustained in future. I mean, this line also is beautifully written by whoever has done it. It says it may be sustained or it may not be sustained. So we don't know. It doesn't say the past performance will not be sustained. So there is uncertainty even in that. So in that case, better to stick to my own asset allocation plan, because I am investing for funding the financial goals of my life. I don't want any surprises there, simply because an external factor per market is not behaving the way I expect it to. Market is not under obligation to behave in line with my expectations. So let it behave the way it does. I will ensure my portfolio is built in such a way that I can absorb various shocks. You know, there's a beautiful proverb in English which says, you can't prevent the storms, but you can adjust the sails. So when you're going on the sea, the storm will come and go, but can you adjust the sails? Yes, and that adjusting of sails is asset allocation plan. So that's number one. Number two, mutual funds play a humongous role in helping one arrive at proper asset allocation, because number one, you got to have your objectives very clear. It's like your journey plan. I want to travel from Mumbai to Calcutta. That's my journey plan. And then a mutual fund is like a public transport. It tells you exactly what to expect. It's mentioned in the investment objective, it's mentioned in the investment plan, it's mentioned in the asset allocation for the scheme. Now I have to pick and choose. So if I have to travel from Mumbai to Calcutta, I've got to take a flight. But if I were to travel within Mumbai from, let's say, Borivali to Churchgate, I'll take a local train. But if I have to travel from Borivali West to Borivali East, I'll take an auto. The vehicles would change depending on my journey plan. But then I exactly know that auto cannot take me from Mumbai to Calcutta. I mean, it can take technically, but it'll take years. And a flight cannot take me from Borivali East to Borivali West. So the vehicles have to be appropriate in line with my journey plan. And mutual funds, because of the transparency about investment objective, asset allocation, and investment style, they tell me a lot which a vehicle is going to be appropriate for which segment of my journey. And that's how you have liquid funds for very short-term requirements, debt funds for medium to long-term requirements with the decent amount of safety built in, and equity for long-term requirements, wealth creation, long-term goals, etc. And then there are multiple facilities available, conveniences built in, like any-day liquidity, daily NAV, SIP, STP, SWP, so many conveniences built in. So I think that's how mutual funds can be used to build a customized portfolio for oneself.
Thank you so much, Amit. I mean, it was like, on the rainy Sunday, so many things coming from your side. It is like, for me, I'm looking at Amit Trivedi, 80, 80, 80 here. 80 is avoid temptation. I mean, according to the tolerance and according to the travel, appropriate travel plan, all 80,
Wow.
80, 80.
Wow.
So if I may add something to that analogy, which Amit very nicely put about the driving speeds. So there is something that we tend to ignore. There are limits on driving speeds. So Mumbai-Pune Expressway recently went up from 80 to 100. So while you might, find the road empty and be tempted to do 150, you are likely to get caught and be penalized. So same goes for investments. There are investments which are coming up, which might not be legal, which might not probably be covered under any laws right now. Accidents might happen if you go there, and there might be penalties to be paid. So be careful of those legal limits that allow you to do certain things. So I think people know what those kind of investments are. There are a lot of things which keep coming these days, and because of social media, they also get spread around very fast.
Fantastic. We have moved from 80 to KT. I mean, keep from the temptations. That's a fabulous way. And What a great analogy to convey the message. I mean, asset allocation is the key. I like the Amit ji, you said how the mutual fund can become a mutual friend in every part of your life. When your goals, you can get at asset allocation, and the way you allocate, the way you travel, which gear to travel, how long to travel, where to slow down, where to move on. The mutual funds can provide you. It's a short term, medium term, long term. Within the short term, again, you have various things. For example, for your breakfast, you have a different kind, but not one kind of breakfast. And lunch, you have a different kind. Dinner, you can. But holistically, if you can look at your entire meal plan, mutual fund can be very, very sufficient. You can, some of you can digest little lesser. You have an SIP, little you can put it. Some of you can take little larger call. You can have an STPs, and some of you want to get more calories burned. You have an SWPs to take out. That's the way mutual funds works. And with this, I'll go back to Kiranji. Kiranji, earlier we spoke about the investment goals for the investors. I mean, according to the goal, what kind of asset allocation we can have. Now, there is one goal for everyone. Like none of us can skip is to have that retirement goal. And what kind of asset allocation is advised for the retirees and either just retired or various stages of retirement? Is there is a difference to retirement even for the retirees? It's somebody lives almost one third of their life in the retirement. Asset allocation plan may not be the same from the just retired or somebody is have a long time in the retirement.
Right. So I think it's a very important aspect to manage asset allocation after you have retired. So for that phase, the key idea is to have enough income at any point in time, because you don't have any other source of income except your investments for a major period of the retired life. Second aspect that needs to be taken care of is that there is enough lump sum available for any exigencies. So if there is a health issue, or if there is something that you want to support your children or grandchildren for their education, or some other things, so there should be sufficient available for that as and when you need it. So once these two things are taken care of, I think asset allocation on a broad level is divided probably between equity and debt only in that stage, because real estate is probably something that they will be getting rental from, or retirees can always convert the real estate into financial assets and put it into the two broad buckets of equity and debt. So as long as the key elements are taken care of in terms of your income generation, the rest can be in equity. Now let me take this as an example. See, somebody who's at the age of 60 just received this PF money, and there are some other investments which have been there. So out of that, I would say that first ensure that next 5 to 7 years of your income is in debt assets, so that you are safe, or you're not worried about the volatility of the market. Beyond that, you can look at hybrid products. You can look at hybrid mutual funds. You can look at equity. You can choose both stocks and equity depending on your understanding and your level of comfort and convenience of operations. So this is how you can broadly split it. Now, for people who are more conservative, you can have a larger allocation to debt products. So say, for example, somebody who's very conservative can maybe have 7 to 10 years of money into debt, and the balance can go into equity. On the other side, if somebody has a corpus which might not suffice for a very long period of time, they will have to balance this very finely. They cannot afford to have 5, 7, 10 years of money in debt, because then there'll be very little left for growth. And when inflation plays out, and in a few years the income falls short of what is actually required, you will not have an asset to dip into to buffer those income levels. So it becomes very essential when the corpus is limited. Whereas for somebody who has ample income, which will last for a lifetime, it is broadly keeping some amount safe, and the rest can go into equity, because that will also be a legacy that they can leave behind for their children if they so wish. So it depends on what amount of corpus you have accumulated and what is your basic risk tolerance level.
Thank you so much, Kiranji. I mean, we will tell audience like next month session when we do on financial freedom, we can have a detailed session on the retirement. And of course, Kiranji has given a very good analogy how the retirees can have an asset allocation. And this is one area we can't go wrong. We can't have falter. And you need to have a mind game and investment game both in place, because you are vulnerable for such an emotions which can impact on your health. You need to ensure that your asset allocation is appropriate. We don't need to be greedy, and but at the same time we need to get enough returns than the inflation, so that our money can survive beyond our retirement. With this, I'll move back to Amitji. There were also some questions in audience I have seen on the cryptos, and the last 2 years we have seen many of our millennials entering into the stock market, and probably a couple of years, may initial part could have been, the honeymoon could have been fabulously good, and now the real test, markets have moved from the new normal to the old normal, the real normal, and every asset class has come back to that normal. And at this point of the time, and larger chunk had a good experience to the moving to the very tough experience. I can't say bad experience, and you learn out of these experiences. And it's a and and I have seen like couple of weeks back. In one of the get-togethers, I may take this guy. He's having he's an youngster, he's a millennial, but almost he accomplished his financial freedom because of various investments have come out well. But my interaction with him over last 2 years to 2 weeks back, like he has lost whatever he has earned in the last 2 years. In fact, today he is into the negative returns of the portfolio, and it's a sum is quite a good amount of, it's a 200, it's a 2 crores plus kind of money, and literally I was expecting this guy will have a fire and he can retire in 35, 36 years. And this is the story of the youngsters. What is the advice you can give? And is there is anything they need to go back to the basics and look at asset allocation very differently?
So it's a brilliant question. And if I borrow from these scriptures, there is a story in Bible about King Solomon. And King Solomon was not having a great feeling, so he called the wise men of his state and wanted some advice which is everlasting. And then the story, I'm not going to narrate the whole story, but somebody then gave him a very short sentence, this too shall pass. And he inscribed on and then a ring and put it on to remember it at all points in time. Now this too shall pass is often remembered in bad times, but this too shall pass also applies when the times are good. A lot of people forget that. You mentioned a couple of examples of somebody who saw a huge uprun, or a large number of people saw a huge upside. Now look at the situation. So today we are in a monsoon where the rain gods are infusing liquidity in the market. At the same time, the central bank gods are sucking out liquidity from the markets. So while there is rain on one side, the liquidity is going out of the market. In last few years, the same central banks were flooding the markets with humongous amount of liquidity. And when the liquidity enters the markets in big droves, it's like the floods. When water enters a closed vessel, everything that is inside the vessel starts to float and moves up. Now, is it exactly the same thing that happens when the central banks pump in liquidity in the markets, the asset prices move up. So whether it is equity, whether it is real estate, commodities, cryptos, NFTs, or even bonds, every single asset class was moving up post the declaration of COVID-19 as pandemic. So if you look at the March 2020 lows, from then on, there was a sort of unilateral upside movement across all asset categories. And that was largely because a record amount of liquidity was pumped in by governments across the world. And today, interest rates have started getting tightened. And in the United States, the inflation has now reached a 40-year high. The government bonds of United States are available at 5% plus interest rate in the market now. Corporate bonds are available in excess of 9% in the United States. Something that is like sort of unimaginable only a few quarters back, not even a few years back. Now, when that happens, yes, you're going to see those kind of market cycles. So please remember, this too shall pass, whether it is good time or bad time. And when these two shall pass, the biggest benefit that you can, or rather, biggest thing that you can do, the biggest service that you can do to yourself is one of the slides that Rao sir showed in his presentation, he said various different asset classes act as natural hedges to one another. When one moves up, the other may not move up, or when one moves down, the other may move up and absorb the shock. So while you may not get humongous upside of an individual asset category, but you will be spared from that huge downside of a single asset category. And that is the whole purpose. The purpose is not to beat the market, not to beat the neighbors. The purpose is to provide for your own basic goals, which are either your responsibilities or your dreams. But you are actually investing to provide for your financial goals and not to beat somebody else in the game. If you look at it that way, then the entire asset allocation plan would be exactly in line with your own financial situation, your own financial goals, your own preferences. And once that is done, I think more or less you will have a peaceful time.
Thank you so much, Amit. And I'm sure this advice for the millennials can go well, those investors who have come. Good you started investing, but great you can take care of the precautions and have an understand. And to put it, to sum up what Amit ji said is you need to, during good times, don't be over bullish, and the good times you preserve, and the tough times you persevere, and the long term you can have a you can have a prosperity. Otherwise, the prosperity can get vanish. And he put it very nicely. This too shall pass. Earlier, I think, ensure that what you got. That's where asset allocation helps. That's where rebalancing will help. Probably I'll go back a little later to Amit ji to check on what kind of a rebalancing you can look at. And he summed up very nicely. Don't try to be a smarter hero to beat the market, and market is always smarter to beat you. All that you need to is you need to meet your goals, not to beat the markets. And with these goals, I'll go back to Kiranji. Kiranji, this question, you are, thanks for being our brand ambassador for her initiative, the educating women on finance, and your wonderful book, Money Wise, Education to the Women on Money, and taking that book as a Bible for us. I'll ask this question to you. It's always said men are from Mars and women are from Venus. And is that portfolio also need to undergo accordingly? I mean, what kind of asset allocation plan for the woman is advisable?
Well, sir, our book Money Wise actually, says this, that money is gender agnostic. So money will not realize whether it is being used by men or women. The circumstances are different. So what I would say is that asset allocation rules and principles will not change with gender. For women specifically, if we are talking, women need to be more aware of what kind of life situations they can be, and that might impact the way their asset allocation might require a change. So it is not based on any financial products or other things which are common across genders. So in case of women, if we talk about how the life cycle goes, so there could be periods of break in a woman's career. So if a woman is working, there might be periods of sabbatical. Maybe that could be maternity leave, or there could be taking care of aged people in the family when they are sick. So generally, it's the woman who tends to take the break in her career. So at that point in time, her investments will take a break as well. She might not be able to invest at that point in time, and she might in fact need to withdraw. So it's like a mini retirement phase. So accordingly, the changes in asset allocation need to be done. So probably, for those period, if you're anticipating something like that is coming up, there could be a little more allocation to debt from where this, withdrawal can happen. So that is a way of handling these kind of short breaks. But otherwise, if you talk of longer term goals like education for children, or say for their own retirement, when couples are planning, they will have a family level asset allocation, unless they specifically wish to, have separate investment portfolios for each of them. Otherwise, most of the goals are usually family goals. So buying a house, or, going for a vacation. So these kind of goals are common to a family. So you really cannot have a different asset allocation for men and women.
Thank you so much, Kiranji. I mean, money is a gender agnostic. That's a way to look at. You have a common. I mean, you need to look at the asset allocation principles is the same. It will not change. The turbulence you undergo is the change, but your own profile will make the difference, how you intend to put, where you are putting. Amit, earlier we were talking about the rebalancing and why the rebalancing is required, not only to preserve, but also, conserve what you got and you can get there right. And what exactly this portfolio rebalancing and how that can benefit to the investor, and how often one need to do. Probably we may little later go to Kiranji, what she advises for our investors on the rebalancing, and how we can do that.
So, sir, essentially, the way the asset allocation was done for any investor was based on the situation of that person at that point in time, and accordingly, the portfolio was aligned to serve the financial goals of the individual. Now, let's say today somebody has done analysis of my situation and advised me a particular asset allocation plan for a goal which is 5 years down the line. When I look at July 2023, exactly 1 year from now, then that goal is now 4 years away, not 5 years. So first of all, that factor of time has changed. Number two, in that 1 year, the various components of that investment portfolio, let's say equity market might have moved up faster than debt markets or otherwise. And because of that, the percentage allocation across asset classes would also have undergone a change. The third thing could be my own income expense situation also might have changed. And in such a case, you got to rebalance. But let's keep the individual situation aside for the time being. If I were to look at a very long-term portfolio and assume that I started with a 50% allocation to equity and 50% to fixed income assets, a year down the line, if something has changed in terms of percentage allocation between the two, then let's understand what's happening. Why did I have that 50% allocation to debt? Because going by my profile, and let's use a broader term, risk profile. Going by my risk profile, I needed that safety in portfolio. My goal, I need equity asset which generate superior returns. So it's a sort of balance between my requirement for certain returns and my ability to handle the risk of that asset category. And that's how the allocation was done. Now, if that allocation percentage has changed, that means I need to restore it back to that profile, my personality that we started with. So it has to be restored back to 50-50. I did mention about 1 year. There are various frequencies that can be used. Ideally, once every year it should be done. A lot of times people recommend that, once in 6 months, you should rebalance whatever frequency you choose. But if you don't do it once in 2 years, then I think you are, not properly doing that rebalancing activity. And sometimes the portfolio would get skewed in favor of one asset category and you will get some negative surprises. Now let's come to the other part of rebalancing, which is where one of the standard things that people use, most financial planners, most financial advisors use, is that equity is not used for short-term goals. They allocate money to equity for longer-term goals. So let's again come back to the goal, which was, let's say, 10 years away, and 5 years have passed. So when the goal was 10 years away, I had a larger allocation to equity. But now the goal is 5 years away. My equity allocation should be reduced because now I don't want to be vulnerable to the vagaries of stock market fluctuations when my goal is nearby. And when my goal is just 2 years away, then I need to be heavily loaded in favor of income funds and not, or liquid funds, and not so much into equity funds. So rebalancing is to be done at two levels. One is when the portfolio values have changed, you rebalance to the agreed asset percentages, and then when as the goal approaches near, you keep cutting down from the risky asset. So that's how you need to do it. Once you do that, the probability of achieving the goals goes up dramatically.
Thank you so much, Amit ji, and you put it very nicely on rebalancing, how we need to do. Not only the diversification, it will help you to preserve and it will help you to get that. But here, I'll put the question back to Kiran ji. And when we can use this strategy, Kiran ji, rebalancing means sometimes selling the profitable one, but buying the less profitable, last one. And it is like, the fallen prices. It is it not sometimes it is a proverbial acronym, anecdote, which we call catching the falling knife. And, I am exiting from the profitable asset. I am getting to the asset which is not delivered the return. Will that be a good strategy? And how that I can manage not to get wipe off of my capital gains and end up paying the taxes. That is another way to look at.
Right. Sir, what you have put across is a constant dilemma that we face as advisors when we have to practically do rebalancing in portfolios. Because yes, all these factors do come into play. So are you, while you're booking your profits in a profitable asset class, are you cutting the flowers and watering the weeds? So that is a question that we have to keep asking ourselves all the time. Another factor is the taxation, as you mentioned. So each time that you are redeeming from a particular asset class, there would be taxation impact. There could be penalties that are there, and there are asset classes and there are products in which rebalancing is not possible. Like we were earlier discussing PPF, EPF, or say for that matter real estate. Rebalancing is not possible in that. So you have only one part of your portfolio which you actually end up rebalancing. So all these factors do create a problem when you are actually doing the rebalancing. So on a practical level, what we do is that the rebalancing does not happen very frequently. So it might not even happen for a period of 3 years, depending on what is the amount of profit in a particular asset class that the allocation has been done. So it could be, see, it's not, when we talk about 60 equity, 40 debt, it is not a, something written in stone. So it has more of a range that you can go to. Say if 60 goes to 65, are you actually going to make the changes, or will you wait till it touches 70? So that is a very subjective thing, I would say. It is not that easy to decide at what point you will, book the profits and move into another asset class. Again, that will depend on, though the review happens at every point in time. It's not that reviews of portfolio don't happen. Reviews happen on an ongoing basis. But the actual action on the portfolio will happen only when there is a discussion with the client and we see the situation, what is happening, and it is beyond the agreed range on which the asset class has moved. So only then these rebalancing things can happen. Otherwise, it will defeat the very purpose. If you talk about taxation being impacted, so in debt, there is a different long-term period, so in the end, the client might end up paying more tax than the benefit that he or she is getting by rebalancing the portfolio. So these factors have to be taken into account when actually the rebalancing is being done.
Yes, Amitji.
Just to add to what Kiran was mentioning, and just using an analogy, your review is what I really meant when I said once in 2 years you should do rebalancing. That I and consider that as your medical checkup. Process is your medical checkup. You keep getting it done, but rebalancing is changing the treatment. You don't change the treatment course of action just because you've done a review. A lot of times the review says your reports are normal. You don't need to do any. Yes, that's you were mentioning that a lot of times you don't really do any rebalancing, and the review says, okay, everything is fine. The way thanks.
I think we lost Amitji voice.
Some voice issue.
Yeah. Amitji, there is a network issue at your end. Yeah, we can see you now.
Okay.
Yeah. Thanks, Amitji. You're better now. Is it fine?
Is,
yeah. Oh, we lost Amitji. Yeah, I think, Kiranji, you put it very nicely on the rebalancing, and it is definitely not easy. It is advisable to do, but how to do is not easy. And as an advisor, you face that dilemma, and sometimes it will prove right, sometimes it will prove wrong. For example, all of us, when I anticipate market corrections and it is gone, I need to asset rebalancing, whereas equity has become 60, has become 65. But 60 has also become 70 if I keep holding, because it has gone one way direction. And it's always good. You could have an advisor, and it is an individual call. But then I'll come back to you on the mutual fund side. Right. There are hybrid funds. And sometimes this auto allocation happens very well. And these hybrid funds over a period, if I can look at track record, their returns are equal, or sometimes it may be superior than the pure equity funds. Because of a rebalancing and auto allocation. And what is that you suggest to the investors on the hybrid funds and the allocation funds?
Right. So that's a very interesting category of funds that is available to people. So see, I would say that psychologically what happens is when there are products which are very simple and easy to handle, people feel that they are not getting something very exotic. So I would say that it's more of a psychological play. So I think the balanced advantage funds or the asset allocation funds are a great category to be in. So you are kind of, if you're doing it yourself, or even if an advisor is there who's helping you create your portfolio and manage your portfolio, asset allocation funds or hybrid funds or balanced advantage can form a part of your core portfolio because it takes care of two things. One is, it takes care of any kind of timing issues that might be there because there are already formulas built into the fund when they will buy asset, when they will buy equity or when they will sell equity. So that's already inbuilt. So the human bias is taken off there. Second, because the buy and sell is happening within a fund scheme, there is no taxation impact on the investor. So you save a lot on, say doing it yourself in a separate equity and a debt fund. So like if you want to book profit in an equity fund, you sell. If it is a short term, you will have to pay 15% tax on that particular profit booking. And if you're selling from debt, that amount will be added to your income if you have not held the fund for more than 36 months. So that thing is taken care of by if it is happening within the fund, say in a hybrid or a balanced advantage category. So you don't get impacted by taxation while at the same time the rebalancing is happening. So it could be a great category to be in. So I would say that it is a very simple to understand category. While selecting which kind of fund do you want to go in for, you need to understand there are different kinds of, say, balanced advantage funds. So balanced advantage fund can be a pro-cyclical fund or a counter-cyclical fund. So the kind of return expectations can be very different from these different types of funds. So pro-cyclical is something that goes on and adds more of, say, equity if it is going up. And a counter-cyclical will be the reverse of it. So when the equity is going up, they will sell equity and they will buy more debt. So depending on what your belief is and what philosophy of investing you follow, you can select any of these category of funds. Likewise, you also need to understand the difference between a balanced advantage and a pure hybrid fund. So while balanced advantage is supposed to do the rebalancing on an ongoing basis on a predefined formula that the fund house has taken up in that particular scheme, a hybrid fund will have predefined holdings and that more or less stay static. I mean, they will not keep changing as the market circumstances change. So it might not, behave similarly to a balanced advantage fund, whereas on an overall basis, they are still hybrid funds. So depending on what you are looking at, what is your risk tolerance, you again need to choose wisely between the categories of debt funds that are debt and hybrid funds that are available to you. So I think it is a very good option available to most investors.
Absolutely. For any beginners, any investor to start with, these are the funds to start with. I mean, either you have a hybrid fund or balanced fund, and hybrid funds and all both the kinds of funds are tend to be over a period of time. Market comes back to normalcy, and it's the temporary buoyancy gets down, and this too shall pass. That is the time fund manager is behaving on your part, and you can do. Taking this clue, there are some questions which have come in, and this question is not only balanced fund but about the international funds. And this is a question coming from Harsh Bhatti. And how much asset allocation should be given to the international funds? And he has put some considerations following points. Given the person is in accumulation phase and he can take high risk taking ability and having a long term perspective and intend to have a wealth creation as a goal.
Right. So international funds, I would say, see, equity itself is the highest risk category. And within equity, if you talk about international funds, they are again in the highest end of that risk parameters for equity. So basis that, somebody in the accumulation phase is probably in a better position to look at international funds. While I would not say that somebody who's a senior citizen would not look at it. But in accumulation phase, definitely there can be an allocation to international funds. Now, how much? is something that you need to sit down with your advisor and decide. So how much cannot be a thumb rule or something that can be given on a general portal. So that has to be defined in terms of what your overall portfolio looks like and what are your goals and where do you stand currently. So I think I would leave it at that. And international definitely is a great option to have in terms of geographical diversification of your investments.
Yeah, thank you so much, Kiranji. And there's the same Arsh only is asking, and I'll give a follow-up question since Amit ji is back. In between, we lost him. And Amit ji, this question comes is earlier the question was how much to international equity funds. Kiranji was answering this question, and here is a question which has come. I mean, after taking into consideration of some funds coming in a fiasco, I mean, during COVID times, how much allocation should be given to one particular mutual fund only? I mean, what kind of different mutual funds we need to use, or what kind of limit I can do for one particular fund house?
Now, that's a tough one to answer actually, because first of all, you have different asset categories across which you spread the money. And then even if you decide to spread money across mutual fund houses within the same category also. So let's say if you got equity funds, debt funds, gold funds, and liquid funds, and then out of these four also you want to divide money across different fund houses, then there's a danger of becoming too many funds to handle, and it may offer a different set of challenge. Having said that, there could also be a situation wherein the example that you was quoting happens. But now let's understand the probability of both. You to handle that portfolio on a very regular basis. So if there are too many funds posing a challenge of managing the portfolio, then the chances are that you may not be interested in focusing properly, or you may make mistakes which could turn out to be costly. On the other end, the kind of situation that took place in early 2020 was actually the first ever time since mutual funds came to India. It's not happened at all ever. And that too happened during unprecedented time period when there was a global pandemic and lockdown across the world. So are we looking at a repeat of that happening? Well, but having said that, if you still have that concern at the back of your mind, I would say divide within the asset categories. Don't go beyond 2 or 3 fund houses, is what I would say. Otherwise, you'll be spreading yourself too much, and that could be posing a challenge. Now, let's look at the actual scenario that took place. And the challenge was more on the liquidity side rather than the investment performance side. The liquidity was stopped for that particular investment avenue. And if that's the case, whenever you are closer to your goals, it is the liquid money that you need, and you got to worry about that liquid portion. Your long-term portfolios can still be concentrated within one fund house also, if you think that serves the purpose. Also evaluate with the help of your advisor, evaluate the liquidity situation of the product category that you are investing in. Take, for example, within debt funds. So debt funds invest in debt markets. Now, if your money is in money market instruments or government securities or AAA bonds, then that segment of the market is reasonably liquid. But if your money is in lower credit quality bonds like the credit risk funds invest in, then in that case, the liquidity of those bonds anyway is poor in the market. So depending on what kind of money that are required in the short term, take care of that liquidity requirement by a proper assessment of schemes. Otherwise, long-term money, you need not spread too much. Liquid money, 2 or 3 fund houses, that should be enough. I think that's what my take on balancing between 2 different challenges.
Thanks, Amit. I mean, earlier you spoke about liquidity on portfolio for asset allocation ke time of individual liquidity. There is one question which has come at that point of time. Is this question is coming from Mr. Rajiv Jain. Is there any golden rule of liquidity for an individual?
So most of the golden rules are not really golden. They also the same line applies this to shall pass. So something is golden today may not be golden tomorrow. There are broad principles that you can look at. Number one, the ideal situation would be when you have enough in absolutely liquid assets to fund all your lifestyle expenses and all your financial goals. And that ideal situation doesn't happen. So what do we do? Now we have to strike a balance. So first of all, take care of your short-term and immediate-term requirements, be it your regular household expenses or be it your short-term goals. EMIs to be paid, insurance premium to be paid, to be included in that. So whatever you have to spend in the next short-term period, now this short-term could be defined as 3 months, 6 months, and depending on the situation, it could be 1 year. So now what is that situation? So if I'm working in a very stable employment with regular sort of very highly secured kind of a job, say regular salary, in that case, that regular cash flow coming from salary takes care of large part of my expenses, and to that extent my liquidity contingency requirement would be shorter. But if I am a self-employed person with high ups and downs in the income, quite vulnerable to the economic cycles, in such a case my liquidity requirement needs to be enhanced in terms of my time period, so expenses for that period. So that's the golden liquidity requirement. But the moment you also include your immediate to short-term goals into that liquidity requirement, then that becomes your principle, which takes care of this golden rule that you are asking for. So that's a golden principle. Whatever you are likely to spend in next 3 months, 6 months, 1 year, 2 years, kind of budgetary allocation that you've seen, do you have enough liquidity there? But the moment you look at liquidity, please understand there is a difference between the liquidity that we are talking about here versus the operational liquidity provided by various instruments. Take, for example, equity markets are highly liquid. But does it mean that my short-term requirements can be parked in that equity market? No, not really, because that liquidity could come at a huge cost called volatility. The prices could be high one day, or the prices could be low the other day. And when you need money, if the prices are low, then that liquidity is of no use. So the liquidity that we are talking about is in instruments which are safe, and money can be withdrawn at a very short notice without any loss in value.
And Kiran, this question comes to you. I mean, he is writing specifically to you. It's Atul Chaudhary. Question to Kiran ma'am. I'm regularly investing in SIP, STP, one small cap, one mid cap, one large cap, one flexi cap over last 6 years. And it's assuming it's if it's gone for me and totally for the long term point of view. And I do have one real estate investment which is generating rental income. Do you think have some gold in physical form? Do you think I need to follow an allocation?
Well, actually, the details that you have given, that shows that a large portion of your investment is in equity. That's what I'm presuming from the names of the categories that you have given. So whether that really, helps you to take care of all your requirements, what Amit was just talking about, in terms of liquidity for your near-term goals, that should be taken care of as well. So while on a broad basis, you might be, doing good for your long-term goals because equity will support that, real estate will support that. But what about your short-term? So in short term, you can neither sell your real estate nor, there is always a risk of not being able to withdraw from equity in terms of the equity market being down while you need the money. So liquidity definitely is available, but it might not be wise to withdraw from the equity portfolio, which might be aligned to more to your long-term goals. So in that circumstances, maybe yes, you need to have some kind of tweaking to your portfolio to take care of your asset allocation. That's what I can say.
Yeah, thank you so much, Kiranji. Amitji, I want to have a crisp answer on this for you. It's NFT. This is a Prakar Goel. NFT or cryptocurrency. Will that can be used for asset allocation?
When people do use it, but I'm not in favor of that simply because there is too little information available on the underlying value there's a lot of speculation on some of the cryptocurrencies may become mainline currencies. But then with 25,000 plus coins available in the market, you don't know which would, if at all, if something becomes, you don't know which one. So to that extent, it doesn't really, it becomes too much speculation. That's point number one. And as far as NFTs are concerned, once again, it's an extremely broad term. You are buying any sort of asset in a digital format. I would wait for NFT which provides cash flow to me with the solid underlying asset at the back end. Till then, personally, I'm not comfortable because both these look like ideas whose time has yet not come. In my mind, I'm unable to understand.
Fantastic, Amitji. Unregulated is out from the allocation. I mean, get into the regulated proof
Yes,
of
and then
assets.
unregulated, and both are unregulated. So to that extent, there is no legal recourse also possible, because you've seen so many frauds or defaults happening in this space, and people ask, going from pillar to post to recover their money, and then they don't know the recourse.
Yeah, strict underline is avoid unregulated piece. And coming back to you, Kiranji, this is a question coming from Mr. Vinayan Kumar and Nambiar. Suppose I have 1 crore to allocate, and I can run my monthly. How I could allocate this saving so that I can run my monthly expenditure? As you can assume that I have no income, and it's very difficult. It's each for individual. But what is your answer for it?
Well, Mr. Nambiar, I think you should, go and meet an advisor, because this is a very specific question for your portfolio. So broadly, the rules that will apply to this kind of scenario is where you are depending entirely on your corpus for your income requirements. You'll need to first define how much income you need to draw on a monthly basis. Now, basis that, a portfolio can be created wherein, say, if you're talking about 50,000 a month, that is 6 lakhs a year. So you need to have 6 into 5, that is 30 lakhs into something which is very safe, so that at least next 5 years, you know that your cash flow is in place. And beyond that, then you can decide how much more you want to keep in the safer assets. And the balance can probably go to hybrid funds, or they can go to equity, as we were discussing earlier. So on a broad parameter, this is what you can do. Obviously, there are external concerns as well, whether you have health insurance or no, whether there are any dependents on you, either your children or your parents, or maybe other family members who could need some kind of financial assistance in the near future. So that will again impact what amount of money you keep into your safer assets. So I think based on all these criteria, you can arrive at a portfolio which suits your particular requirement.
Thank you so much, ma'am. And Amitji, this is a question coming from Muthulakshmi Sundaram. I mean, what is the ideal percentage of first allocation for the mutual funds, large, mid, and small cap? Is there any methodology?
So there's nothing ideal that can be applicable for all investors. As I've said earlier, and in this program, we've repeated a number of times, but I think it's important to remember that personal finance is personal. Each individual situation now, can there be a difference between small, mid, and large cap allocation? Well, there again, there could be two approaches. One, you do it yourself. Second, you leave it to the expert fund managers to decide, depending on wherever they see value. So there are flexi cap funds available. You can straight away put money in a flexi cap fund without worrying about how much to allocate between small cap, mid cap, and large cap. The fund manager would decide that. If you think that you don't want to completely leave it to the fund manager, use multi-cap funds where at least minimum 25% is invested in each of the 3 categories. So there are multiple approaches, and then comes the question: should you do it yourself? No, my sense is if such an option is available, why do it yourself? And as Kiran was highlighting while talking about the hybrid or balanced advantage category, because in a flexi cap fund, the allocation between small, mid, and large cap is changed within the scheme itself. There are no exit loads and there is no taxation. And to that extent, also, it becomes a far more efficient product. So without worrying about, simply pick up a flexi cap fund and your work will be done.
Thank you so much, Amitji. And coming back to Kiranji, this is a question coming from Swaminathan Shivakumar. I am a retiree. When I was in service, I never thought mutual funds. And now I realize the importance of the mutual funds. I am planning to invest and putting lump sum in mutual fund schemes. to give a good return over a period of 4 to 5 years. Now I cannot go for SIP. What is your advice for me?
Well, Mr. Swaminathan, see, SIP is actually only a mode of investing in mutual funds. So depending on what stage of life you are, you can either choose a SIP option or you can, put in a lump sum investment. So that doesn't really matter. So don't worry that you are not in a stage of life where you can do an SIP. So SIP is more suitable for people who have an income coming at a regular interval. So salary comes in monthly, so you're investing monthly. So in your case, you already have a corpus which is there because you're retired. Now you're looking at allocating that corpus into various categories so that you can meet maybe your income requirement or other goals that could be coming up sometime in your retired life. So it is perfectly all right to use the lump sum to enter mutual funds. Now, whether you put it all at one time or you use something like a systematic transfer plan, which can help you move from, say, a debt product to an equity product over a gradual, period. So that will depend on what is the amount, what are your goals. So as I said, I mean, you cannot really specify things unless your entire life situation is known. So lump sum is just another method of doing, like SIP is a method of investing in mutual funds on a monthly basis. So don't worry on that bit of it. So you can definitely put in lump sum and use the benefits of mutual fund for your retired life as well.
Thank you so much, Kiranji. I mean, you can put lump sum or you can use a STP route to allocate over a period of time, and hope Swaminathan ji, we have answered you. And Amit ji, I mean, I think I'll have another question, and we may run another 2-3 questions so that within the time we can complete. And this is coming from Onkar Bandare, I mean, it is predominantly on the market, but how to time the market? I saw many people who buy when the price is high and the market is down, they will panic and sell. How can I solve this problem?
So first of all, don't time the market. The very attempt of timing the market often becomes counterproductive because it's almost impossible to predict whether the current run would continue or it would reverse. So in rising markets, we don't know how long that rise continue, and we don't know when would it revert. Similarly, in the falling market, we don't know how long will it continue and when would it reverse. So these are impossibilities. So don't really time the market. If you don't do that, then how do you take care of the volatility of markets? And that's where the fundamental principle of asset allocation comes in. Now, whether you do a simple fixed allocation that a lot of times people talk about, a certain percentage of money invested in equity, certain percentage invested in debt, certain percentage invested in gold, etc., etc. You can do that. You can look at certain percentage invested in Indian equity, certain percentage in international equity. So these are options available. And because when something goes down, something else may not be going down, it automatically provides that perfect hedge, as Rao sir mentioned in his presentation also during when he showed that slide showing performance of different asset categories. So simply do that and stick to that asset allocation plan with periodic rebalancing. So that is number one. Number two is, when equity markets are volatile, the ideal way to benefit out of that is through an SIP, a systematic investment plan. And there is a popular concept that almost everybody talking about SIP discusses. It is called rupee cost averaging. When you invest a fixed amount periodically, depending on the NAV. So in a high market, because the NAV is high, amount invested divided by the NAV, you would get those many units. So when the NAV is high, you buy fewer units. When the NAV is low, you buy more units. So when it is cheaper, you buy more. When it is costlier, you buy less. Automatically, your buying program ensures that the volatility turns in your favor. Now, these are some basic things that you can do. Now, if you want to go beyond that, there are various balance advantage funds that use certain valuation factors or cyclical factors and keep rebalancing, which with an assumption that the idea is not to take humongous advantage of timing the market, but the idea is to curtail the volatility and to give you a smoother ride. So you can look at multiple approaches. First, I said asset allocation. Second, I said SIP is a great way. And third, you can straight away take advantage of the balanced advantage funds.
Thank you so much, Amitji. And Kiranji, this is a question again coming on the retirement. Probably this could be the last question to you for the day. This is Sanjay Arora. I am retiring in next 3 years. My major savings on PF and pension fund. And I am also investing in SIP through the equity in the large cap and flexi cap. Now, should I continue my SIP till retirement or should I go for STP to the debt funds? And my PF and pension funds are more than 2/3 of my total savings. What do you suggest?
Right, Sanjay ji, very interesting question. So if you just look at what we have been speaking through this session, so there is asset allocation where you need to look at the overall portfolio. So if you say that 2/3 portion of your investments is in PF and pension funds, that is a huge portion in debt. So you already are a lot into debt. So you can choose to continue your SIP in equity funds if you can, because that is a smaller portion of your overall assets. And also understand that when you retire, say at the age of 60, you have another 30 years to go in terms of life. So you will need to have some exposure to equity. You cannot be 100% in debt, because inflation is definitely going to demand that you have more income growing through the years in your retirement as well. So that portion has to be taken care of through the equity investments, because that's one of the better options to beat inflation. So in those terms, yeah, overall basis, I think it makes sense for you to continue your SIP into equity.
Yeah, thank you so much, Kiranji. I think there are many positive feedbacks and lot stuff, and some questions which are relating to the insurance, some relating to the stock, some relating to the cryptos. I skipped it fully. And there is a question which is coming is from DV Krishna Kumar. What age and stage of our life we should have do the asset allocation? Probably, Mr. Krishna Kumar, at every stage of your investing itself, your investment plan first, then have an asset allocation plan to your investment planning. Then you should have a discipline and commitment to continue with this. And there is a many conversation. Request for the PDF of this presentation. This presentation is going to be on our website. You can visit and you can look at this is a question. What is it? Sutharan. And second, Atul Naidu, this presentation, yes, we are keeping on the website. You can come there, and right now it is also there on the Facebook. Probably today, whole day, it will be available. You can have a look at that. Thanks, Rakesh, for the positive feedback on excellent information. And then we have where we can get the recording. It's on our website at mutualfund.adityavirlacapital.com. Please come down there and you can look at you can get the recording. I think many of you asked for the recording. It is available. Thanks, Shankar, for your compliments to great session. Thanks, Neha, for that compliment. Thanks, Nidhi, for your compliment. Then thanks, Mr. Namdev, for your feedback. Thanks, Mr. Anil. It's useful to you. We are very happy and very glad, and many other positive feedbacks. With this, I can stop here, and I can also invite. Where is this? Matthew sir to come in and join us. Anand, make Matthew sir a co-host, and Matthew sir is back here. With this, friends, thanks for joining, and it is I'm very thankful to Amit and Kiran for answering as many questions as possible in a wonderful language, and I'm very grateful to both of them. It is AK for one is you should have an asset allocation and you should have a knowledge of asset allocation. And some of them were asking on the trading. I skipped the questions because we believe in investing, not in the trading. And friends, I think I quote Seth Klarman, who speak about stock market is always a story of cycle, but human behavior is responsible for the reactions in the both directions. And volatility of the market is the nature of the market. Volatility of the mind, what you can control. That's where you need to have a right advisor. And asset allocation is key for investing. And hope we have given reasonable information, given paucity of time of 90 minutes. And I'm very thankful to the entire week team and Matthew George and Shri sir and Uman, Sri Devi, and everyone at week, and with which week after week, month after month, we are coming to you. Next session, we will come on the financial freedom very soon. And in the meanwhile, I wish you all a happy Eid, a happy Ashadha Ekadasi, and a monsoon time. Take care of your health and take care of your wealth too with the right asset allocation. And thanks once again, and over to Matthew sir for the concluding remarks. Thanks once again. Wishing you all the good luck to you in your health and wealth.
Thank you so much, Rao sir. Thank you so much, Rao sir. And also to all participants who have been with us on a Sunday morning. Thank you for taking time out. I'm sure it has been very helpful to you. Judging from the comments, there are a lot of compliments coming to all the panelists. Thank you so much for the good words. Um, a couple of things that I always stress is that one pleasure working with this panel is that it's a very ethical and very straightforward panel. All of them are financial professionals with their own targets, their own business, but they never recommend the things that are profitable to them, or they never make personal recommendations, which is a tough thing to do, but the ethical thing to do. And it is wonderful that Raoji, Kiran, and Amitji have always stuck to that. One comment that Amitji put in between is that when something is taxed, it doesn't mean that it's legal. That is very true, because as a media house, I don't know the amount of advertisements that we have foregone in certain asset categories that come to us, because as a policy the week does not touch that, and it's very difficult. It is not easy to say no to money, but certain things in the interest of our readers and interest of investors, we must make those hard decisions. So those are made, and those are not easy. I hope you'll understand and cooperate with us. Thank you so much again, and like Rauji said, see you next month, and until we meet, may God keep us all safe and healthy. Thank you so much.
Thank you so much.
Happy
Thank you,
Sunday and
everyone.
wonderful time. Thank you. We'll take leave. Bye-bye.
Bye-bye.
Bye.
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 Bye.